No question about it, Tyler. You know, the good news is we got a big move up in June, 8% move up in June. The bad news is I think we had some real upside potential, almost as much as 16% when we got to the end of May and the start of June, but we've used a lot of that up. So now, quite frankly, and as I do the numbers, we're about 5% above the level we should be in the current quarter. And the upside potential is no longer that 16%. We're now talking about 8%. So frankly, everything has got to go right. The Fed has got to cut rates 3 times. That's built into the market. And when we think about what Bob Pisani was talking about, and I think he hit the nail on the head, is the earnings numbers have got to come in the second half, and you cross your fingers and hope that they're even better than the kind of slowdown in earnings growth that we're going to see in the second half. Point being, with a valuation being what it is, everything's got to go right.
So they need to be less worse than we might well be building in. Nela, I note that you are above your normal levels of cash, but not necessarily for defensive reasons, more for offensive reasons. Explain.
That's right. That's right. Well, we're long-term investors. We have that long-term outlook, and we use cash as an opportunity to buy when the markets are having a dip. Look, we know that there's going to be more volatility in the markets. It's been a very low, calm market for the last 2 years. That's going to change. We're seeing some more geopolitical risks. But it's not a surprise that growth is slowing. Those tax cuts are fading. We can't have 20+% earnings growth year after year after year, and you're seeing the markets reflect that. There's sizzle in the steak. We think that the steak is still good, and that will make prices still grind higher. That sizzle has to do, I think, with the Federal Reserve and trade.
Nela, would there be specific stocks that you like here? Any sectors that you think are of good value?
Well, we like small cap stocks. We like mid caps. They're more insulated from trade tensions. They're trading at a discount to large cap. We like international. We like to be broadly diversified as long-term investors. But within sectors, we still like tech. They have multiple ways to grow these companies. Yes, there will be some headwinds with regulation, but we're looking at, digital advertising globally taking off. 5G, the Internet of Things, cloud computing, the list goes on. And so the future, we think, is bright for tech still.
You know, Hugh, you say don't bet the ranch, don't stick your neck out, but don't necessarily reallocate. And you have a couple of stock picks that you think could be almost defensive, I suppose, in the context you described. What are they?
Yeah, I listen to Nela, and she's got a lot of respect, and she makes a good point. I think from a cyclical point of view, in other words, we're in a cycle. As you know, Tyler, Kelly, this has been a very long cycle. It's the longest bull market in history. So you've got to be prepared for the possibility that we're going to have a bear market accompanied by a recession. And that's why I'm saying, yeah, I can make the case for that 8% or a little bit further to go in the current cycle, but not a lot further to go in the current cycle. So what I'm saying is maintain a meaningful allocation to equities. It's not over yet, but I'm also saying start to build some defense in. So you get companies like Walmart, Detroit Edison. We've got good dividend yields. They really work well if things start to go bad on us. And so those are 2 companies I would look at. And Apple, it's a technology stock. It's a bull market stock, but it also has a good yield. So I'm saying build a little bit of defense into a portfolio that still says we've got a little bit further to go in the cycle, but not a lot further to go.